Hello everyone, and I hope you all are doing great. So our topic for today is subsequent measurement of IAS 16. So what does subsequent measurement means? For example, in our previous video, we had learned about initial measurement of IAS 16, which means at what value and how the asset will be recorded when it is first bought. Now, in the subsequent measurement, we will learn about how the asset will be recorded in the years to come. For example, in the coming accounting year end, at what value and how the asset will be recorded. So, in order to address this issue, IAS 16 gives us the following guidelines. An asset can be valued using cost model or revaluation model subsequently. Now, before explaining further, it depends on the company's policy whether you want to use cost model or revaluation model. So these two are part of company's policy. Now, talking about cost has following three components. The first one is cost itself, the second one is accumulated depreciation, and the last accumulated impairment loss. Now, cost include the value which we learned to calculate in our previous video, which we named as initial measurement. So you all know now what initial measurement includes. The second one is depreciation or accumulated depreciation. For example, we have been using an asset for only 1 year, so we will calculate the depreciation of 1 year and then subtract it from the cost. In other example, we have been using an asset for example 3 years, so we will calculate the depreciation for 3 years, add them together and then subtract it from the cost. And the last one is accumulated impairment loss. Impairment loss is a sudden fall in the value of the asset. We will be learning in detail what is impairment loss in standard IAS 36. So for now it is just the sudden fall in the value of an asset. So we subtract these two from cost of an asset, and this value is recorded in our accounting books in the year end for the asset. Now the other model is the revaluation model. In revaluation model we have following three components: fair value, depreciation and impairment loss. These two are same like the one we talked about in cost model. The only difference here is about the fair value. Fair value in rough terms means the market value of an asset. I don't want to talk in detail about fair value because it has a separate standard to discuss about. Alright, so for now it is the rough market value of an asset. In this case of depreciation will be calculated again as per the newly assessed fair value of an asset. And the last one is impairment loss, like we talked about, is the sudden fall in the value of an asset. So we will be subtracting from fair value newly calculated depreciation minus impairment loss, and the value derived here will be the new fair value at the year end of an asset. Now the third condition is whole class of asset must be revalued. By this mean, for example, we have a building A which we want to revalue, so we can definitely revalue that building A. However, if we have a similar building to that building A, we have to revalue that as well. For example, building B is similar to building A, so we have to revalue building B as well. Likewise, we have building C, building D and building E, so we will be revaluing all of these. And the last and the fourth point is gain go to OCI and loss go to PNL. This point is very important and I will be explaining you all this point in a bit detail later on. So which means, for example, if we have a gain on revaluing an asset, so it goes to OCI, and if we have loss on revaluing the asset, it goes to PNL. Now later on I will be explaining you all that what does this mean. So if all these four conditions are met, then we can use the revaluation model as per IAS 16.